You buy a rental property. Your neighbor puts the same money into index funds. You both think you made the smarter move. And you're both wrong, because one of you forgot to count the hours, and the other forgot to count the zeros. When you actually run the numbers over 20 years, the gap will make you rethink everything you thought you knew about building wealth. Let's set this up fairly. You have $50,000 saved. You earn $55,000 a year. You're deciding what to do with that 50 grand, and you've got two options sitting in front of you. Option 1. You use it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood. You take out a 30-year mortgage at 7% interest. Your monthly payment lands at about $1,330. You find a tenant willing to pay $1,800 a month. On paper, that's $470 a month in profit before you spend a single dollar on anything else. Option 2. You take that same $50,000 and drop it into a total stock market index fund. No leverage, no tenants, no midnight phone calls. You set up an automatic contribution of $300 a month, and you don't think about it again. On day 1, if you went with the property, you have a house, a tenant, and a story to tell at dinner parties. If you went with the index fund, you have a brokerage account and a confirmation email. It's not even close in terms of how it feels. But feelings and math are two very different things. For the first few years, the rental looks incredible. Rent checks hit your account on the 1st of every month. You drive past the property on the way to work and think, I own that. You're claiming mortgage interest and depreciation on your taxes, shaving a couple thousand off your bill each year. You're building equity with every mortgage payment. Comparable homes in the neighborhood are ticking up in value. Everything about this investment feels real, tangible, and smart. The index fund? You log in once a quarter. The number goes up a little, then down a little, then up a little more. Year 1, 50,000 grows to about 55,000. Year 2, maybe 61,000. It doesn't feel like anything is happening. There's no key in your pocket, no asset you can point to from your car window. Just a number on a screen that nobody asks you about. Now let's look at the real numbers through year 3. The rental has collected roughly $64,800 in rent. Mortgage payments total about $47,880. That leaves roughly $16,920 in gross cash flow. Sounds great, until you subtract everything else. Property taxes run about $3,000 a year. Insurance adds another $1,500. You've already replaced a water heater for $1,200, fixed a leaking roof for $2,800, and dealt with 1 month of vacancy between tenants that cost you $1,800 in lost rent, plus $600 to clean and relist. You're managing it yourself to save money, but that means phone calls at 10 at night, weekend showings, and coordinating repairs on your lunch break. After all real costs, your actual net cash flow over 3 years is somewhere around $2,000 to $4,000. Not the $16,920 that looks so good on a napkin. And that doesn't account for a single hour of your time. Meanwhile, the index fund has taken in $50,000 up front plus $10,800 in monthly contributions. At roughly 10% average annual return, the portfolio is sitting at about $76,000. 0 hours managing it, 0 phone calls, 0 emergencies. But the rental still has leverage working for it. That $250,000 property has appreciated maybe 3 to 4% a year and is now worth around $270 to $280. The equity, the gap between what the house is worth and what you owe, has grown to roughly $55,000 to $65,000. That's real wealth, and it came partly from using the bank's money. That 5-to-1 leverage is the one advantage stock investors simply cannot replicate. Here's what nobody talks about, though. The rent check is the number everyone brags about. It's the number on the YouTube thumbnail and the number your buddy quotes at the barbecue. What nobody mentions is everything that comes out of that check before you actually keep any of it. Vacancy costs you roughly 1 month of rent per year on average. Maintenance runs 1 to 2% of the property's value annually, so $2,500 to $5,000 on a $250 house. Some years, it's a $200 faucet fix. Other years, it's a $7,000 HVAC replacement you didn't see coming that you can't postpone because it's August and your tenant is threatening to walk. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are guaranteed future costs, and they come in chunks of 5 to 15,000. If you're not setting aside money monthly for these, you're not running a business. You're running on luck. And then there's the one risk nobody likes to discuss. A tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That single event can wipe out an entire year of profit or more. None of this shows up in the $470 monthly cash flow number, but it all shows up eventually. By year 5, the reality of being a landlord hits full force. You're on your third tenant. You've replaced the roof for $8,500. You've handled a plumbing emergency for $1,400. You've raised rent to $1,950, which helps, but property taxes and insurance went up too. Your actual cash-on-cash return is hovering around 3 to 5% after all real expenses. Not bad, but not the 15 to 20% return you thought you were getting. The index fund portfolio, by year 7, has grown to roughly $135,000 to $150,000. No stock picking, no market timing. The compound growth is starting to accelerate. The gains on the gains are now generating more new wealth each year than the original contributions. By year 10, the rental property is worth roughly $335,000 to $350,000. Remaining mortgage sits at about $166,000. That puts equity at approximately $170,000 to $184,000. But your total out-of-pocket beyond the original down payment is somewhere between $20,000 and $35,000 in real costs over that decade. The index fund sits at approximately $165,000 to $180,000. You put in $86,000 total. The rest is pure compound growth. 0 weekends spent fixing anything. At year 10, total wealth is surprisingly close. The rental might be slightly ahead thanks to leverage, but it also ate hundreds of hours and concentrated your entire net worth in a single asset in a single zip code. The index fund diversified across thousands of companies and never cost you a night of sleep. Here's where the story fully separates. By year 20, the rental is worth roughly $450,000 to $500,000. The mortgage is either paid off or nearly there. Your equity sits between $400,000 and $500,000. But after 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, total net profit from cash flow might be $40,000 to $80,000 above what you spent. The index fund, at 10% average annual return with 300 monthly contributions, has grown to approximately $420,000 to $460,000. Total contributions over 20 years were $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. Same ballpark, completely different experience getting there. And here's the part that changes the math dramatically. If you bump that monthly index fund contribution by just $200, bringing it to $500 a month. The 20-year number jumps to roughly $550 to $600,000. In the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. Now, if I only showed you the downsides of real estate, I'd be doing what every stock market influencer does. Stocks have real risks people love to gloss over. The market dropped roughly 37% in 2008. It dropped 34% in a single month in March 2020. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible time. Index funds don't send you a monthly check. Dividends on a total market fund yield maybe 1.5% to 2%. On $150,000, that's about $200 a month. That's not replacing anyone's income. Real estate wins in specific situations. If the rent-to-price ratio is strong, meaning monthly rent is at least 0.8 to 1% of the purchase price, cash flow works from day one. House hacking, living in one unit and renting the others, can drop your own housing costs to near zero while building equity. And 1031 exchanges let you defer capital gains taxes by rolling profits into a new property, growing your portfolio tax-free in ways stock investors can't replicate outside retirement accounts. Real estate isn't a bad investment. It's a misunderstood one. The real trap isn't real estate and it isn't stocks. The real trap is picking either one based on a headline, a podcast clip, or something your uncle said at Thanksgiving, without ever running the full numbers for your own situation. So the next time someone tells you real estate always wins or the stock market always wins, ask them one simple question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this changed how you think about your money, hit subscribe so you don't miss what comes next.